North Africa, crossroads of empire, trade, and serious money. Tonight, we're asking a deceptively simple question. Who's the richest person in each North African country? And why does it matter? Well, because in this region, wealth isn't just yachts and stock tickers. It's banks wiring capital across the continent, cement plants building cities, supermarkets feeding millions, and family groups keeping supply chains alive when politics get stormy. Let's start with Egypt. You'll almost always see Nassef Sawiris at the top. Heavy industry, fertilizers, global infrastructure plays, and investments from Europe to US sports. In Algeria, it's Issad Rebrab and family. Cevital, food refining, appliances, logistics. A rare privately built industrial champion in a state-heavy economy. Morocco has been a three-horse race for many years. Othman Benjelloun in banking and insurance, Nassef Sawiris in housing and cement, then Aziz Akhannouch and family in energy retail. Rankings shuffle with markets, but these names shape how money moves. In Tunisia, there's usually no single crowned billionaire. Instead, powerful business families, think Othman Group or the Mabrouks, anchor retail, banking, and food. Influence without the headline net worth number. Family capitalism, Tunisian style. Since independence, a handful of family-controlled groups stitched together Tunisia's consumer economy, importing and distributing food, running mills and factories, operating supermarkets, and building banks and insurers. Two names recur in almost any map of the private sector. Othman Group Holding, or PGH, for short, was founded by the late Abdelwahab Ben Aid and the Mabrouk family's diversified holdings. PGH grew from poultry into a sprawling listed conglomerate across agri-food, building materials, packaging, and consumer goods, and remains one of the exchange's anchor groups, illustrating how multi-generational families turn scale and distribution into market power. Alongside these giants stand other dynasties with deep sector roots, banking/insurance families, e.g., Ben Yedder at Comer, and post-Ben Ali acquirers who picked up confiscated assets during the 2011 transition. Together, these lineages formed a dense network of holding companies and cross-shareholdings that still influences who gets capital, which brands reach shelves, and how prices and wages move. The Mabrouk Group. Retail muscle plus financial leverage. If you shop at a modern Tunisian supermarket or pass a Géant hypermarket, there's a good chance you've touched Group Mabrouk. In the mid-1990s, the family partnered with France's Casino Group to bring the Monoprix brand to Tunisia. They later opened a Géant hypermarket on the Tunis-Bizerta corridor. At various points, the group controlled upward of a third of modern grocery market share, making it one of the three dominant supermarket operators in the country. Even in tougher years, Monoprix Tunisia, otherwise known as the New Company of the House of the City of Tunis in English, remained a national retail bellwether. Governance, controversy, and course corrections. Like many legacy groups, the Mabrouk story is intertwined with politics. Reuters has described Marwan Mabrouk as part of an influential family spanning trade, banking, telecoms, and car dealerships. It also noted his stakes in the supermarket chain, BIAT, and historically, Orange Tunisie. In late 2023, Tunisian authorities arrested him in a probe tied to alleged irregularities around a state-confiscated company, one of several episodes that reflect how Tunisia's governance reset since 2011 continues to revisit earlier privatizations and concessions. Inside retail, the group has repeatedly tried to restructure or relist/delist its Monoprix vehicle to adapt to competition and thin margins, pursuing a delisting around 2022 to 2023 after tender offers lifted its stake, and floating plans to overhaul the chain's cost base and store mix. These tactical moves matter for Tunisia's entire fast-moving consumer goods ecosystem. Monoprix is a gatekeeper for imported brands, local suppliers, and private label strategies that influence price perception and inflation. Why these families still matter. Distribution is destiny. In a small, import-dependent market, retail networks and ports/warehouses can be more decisive than factories. Families like Mabruk, retail, and Ben Eid/PGH, food and materials, sit at choke points where supply chains meet consumers. When foreign exchange is tight or regulation shifts, their buying calendars and shelf decisions ripple through prices and availability. Finance meets the fridge. Bayat's role in sovereign and corporate funding makes the Mabruk BIAT axis systemically important. That gives the family soft power in policy discussions, from import financing to SME credit, far beyond the grocery aisle. The post-revolution asset seizures and resales redistributed corporate control but did not erase family capitalism. Rather, it produced a new balance among legacy dynasties and emergent buyers. The resulting map remains family-centric, with influence exercised through cross-holdings, banks, and franchise rights. The bottom line is Tunisia's economy is still shaped by a few deep-rooted families whose power comes from control of retail shelves, food and materials value chains, and the banking pipes that fund both. Within that landscape, the Mabruk family's mix of modern retail plus banking heft gives it leverage over everyday consumption and macro-level financing alike, explaining why their decisions, restructurings, and legal entanglements draw outsized attention. Who is Nassef Sawiris? Nassef Sawiris is the youngest son of the late Nassef Sawiris, patriarch of the Sawiris business dynasty, and brother to Naguib and Sami. He first made his mark modernizing and internationalizing the family's engineering, construction, and chemicals interests, ultimately separating and scaling them into two listed platforms: Orascom Construction, Engineering and Contracting, and OCI Global, Nitrogen Fertilizers, Ammonia, and Industrial Solutions. He is widely cited as Egypt's richest individual, and his personal portfolio includes a sizable stake in Adidas and co-ownership of Aston Villa through a holding with U.S. investor Wes Edens. The Sawiris story started with Nassef Sawiris' construction firm in the mid-20th century, which grew into the Orascom Group after economic liberalization. Over time, assets were professionalized and restructured. Naguib built telecoms/media, Sami developed resort towns and real estate, Nassef took the heavy industry track. Cement, engineering, and later gas-based chemicals and fertilizers via OCI. That division of labor helped the family scale globally while keeping each sibling's platform strategically focused. What his companies actually do, and why it matters. Through OCI Global, Euronext Amsterdam, Sawiris helped build one of the world's leading producers of nitrogen fertilizers and ammonia-based industrial products. OCI has long emphasized low-cost, natural gas-based production and a footprint that reaches the US, Europe, and MENA. In recent years, it has also leaned into blue/low-carbon ammonia and hydrogen applications, positioning ammonia not only as crop nutrition but also as a carrier/fuel in the energy transition. The company describes itself as a leading European producer and distributor of ammonia, nitrate fertilizers, and hydrogen products and solutions. A crucial piece of the platform is Fertiglobe, a joint venture between OCI and Abu Dhabi National Oil Company that listed in Abu Dhabi in 2021. Fertiglobe aggregates plants in Egypt, Algeria, and the UAE with 6.6 million tons of sellable urea and merchant ammonia capacity, making it one of the largest nitrogen producers in the Middle East and a major exporter to world markets. Fertiglobe's scale links Egyptian and North African gas value chains directly to global agriculture and industrial demand. From a capital markets perspective, OCI has used portfolio reshaping and distributions to return significant cash to shareholders, about $7 billion since resuming payouts in 2022, including large extraordinary distributions in 2025, while pruning assets like Methanex stake sale. That discipline made OCI a yield story during a volatile commodity cycle and showed Sawiris' bias toward active capital recycling. Egypt benefits in 4 ways from the business of Sawiris. Exports and hard currency. Nitrogen and ammonia exports anchor valuable FX inflows during tight balance of payment cycles. Supply chains. Local plants in Egypt plug directly into farmers across Africa, Europe and beyond, affecting yields and food prices. Industrial capability. Operating modern complexes in Egypt upgrades local engineering, maintenance and safety standards. Energy transition options. As Europe and Asia explore ammonia as a hydrogen carrier/fuel, Middle Eastern and North African producers, through vehicles like Fertiglobe, gain a seat at the future fuels table. Orascom Construction remains one of the most important employers and project integrators in Egypt and the region. Orascom Construction has delivered multiple phases of Greater Cairo Metro since the late 1980s and is currently executing the world's longest monorail system along with the LRT, catalyzing urban mobility, productivity, and land values. Beyond operating businesses, Sawiris runs NNS, his family office/investment company, which built Abe's 6% position in Adidas years ago and has stuck with it through cycles. In early 2025, coverage noted the market value of his Adidas stake above $3.3 billion, a testament to concentration and patience in a brand he knows well. Inside Egypt, Sawiris' influence isn't just about wealth rankings. It's institutional. In industry, he helped anchor gas-based manufacturing in a way that connects Egypt to world commodity flows. In infrastructure, Orascom's record places it at the table whenever the state or multilaterals plan large transport/utility programs. In capital markets, the group's listings and distributions, plus the Fertiglobe float, help Egypt and the wider MENA region show that heavy industry can be investable at global standards. OC+1. Globally, his sway derives from control over capacity that other actors, farmers, traders, shipping lines, and even power generators, depend on. That's less about headlines and more about reliable molecules and delivered projects. When nitrogen markets are tight or when a metro line must open on time, counterparties care about execution, not just ownership. Bottom line. Nassef Sawiris is more than Egypt's wealthiest industrialist. He's an operator-investor who built pipes that move both electrons and molecules, and whose platforms export Egyptian engineering and North African gas value to the world. OCI Global ties Egypt, Algeria, and the UAE to global food and energy chains. Orascom Construction lays the rails, tunnels, and plants that boost productivity at home and abroad. Add to that patient, high-conviction bets in Adidas and top-flight football, and you get a portfolio that mixes hard assets with cultural capital. For Egypt, the payoff shows up in jobs, skills, foreign exchange, and urban mobility. For the world economy, it's about fertility of fields, reliability of supply, and the build-out of essential infrastructure. The quiet plumbing of modern life that keeps harvests growing and cities moving. If Sawiris' planned pivot to U.S. infrastructure via an Abu Dhabi-listed industrial champion comes together, expect the cross-current between Cairo, Abu Dhabi, Amsterdam, and American growth corridors to get even stronger. Now it's time to talk about Morocco's Aziz Akhannouch's energy/retail role, and what it does for Morocco. Before he became Prime Minister, Aziz Akhannouch was already one of Morocco's most prominent businessmen as CEO and principal shareholder of Akwa Group, the diversified holding behind the retail network Afriquia Gas, liquefied petroleum gas distribution, and other downstream energy and services. Public profiles, Forbes, biographies, consistently frame him as a downstream energy magnate who moved from a long run as agriculture minister from 2007 to 2021 into the premiership while retaining family ownership of Akwa. What does that mean for the economy? In practical terms, Akwa's networks keep Morocco's wheels turning. Service stations, depots, liquefied petroleum gas cylinders, and associated logistics that reach households, farms, and industry. In a country with lengthy supply chains, from Atlantic ports to remote inland towns, reliable downstream distribution is a backbone function. It underwrites mobility, cold chains, and the everyday economics of small and medium-sized enterprise. That business footprint intersects with public policy in obvious ways: pricing regimes, competition policy, subsidy reform, which is why the group, and Akhannouch personally, often sit at the center of debates about cost of living, sector competition, and fairness. From a development angle, scale and formalization are the upside. Large, audited players invest in storage, safety standards, and traceability that reduce systemic risk and raise service quality. From a political economy angle, concentration is the challenge. The coexistence of high public office with family control in a strategic sector invites scrutiny. The benefits to Morocco are tangible: jobs, capex, national coverage of fuels and liquefied petroleum gas, and the ability to execute network upgrades quickly. The policy task is ensuring that market rules are transparent enough that those benefits are shared, competition is real, and consumers see pass-through when international prices move. Akhannouch's unusual crossover, as a business leader turned head of government, keeps that tension in the foreground, but it also puts someone fluent in the supply chain realities of energy and retail at the helm during a period of global commodity volatility. Sudan's Osama Daoud was born in 1951 into a trading/engineering family. His father, Daoud Abdellatif, had acquired and then indigenized a foreign machinery agency that evolved into Sudanese Tractor Company or Sutrac, Caterpillar's historic dealer in Sudan. In the 1970s, as state ownership ebbed and flowed, Osama entered the firm, took on sales and operating roles, and helped steer the company back into full private ownership. The engineering arm was rebranded DAL Engineering, taking the initials of his father's name. Those years taught him the two skills that would define his career: import-side logistics, keeping machines, parts and inputs flowing in a hard currency scarce economy, and after-sales service at scale, keeping fleets, mills and farms running. By the early 1980s, he began knitting together a conglomerate architecture: engineering and earth-moving, the Sutrac/DAL engineering lineage, food and agribusiness, automotive, and later property, healthcare distribution, and education. In the 1990s, 2000s he accelerated into consumer staples: flour, dairy, beverages, building brands that would become household names in Khartoum and beyond. Today DAL describes itself as a multi-sector group spanning food and beverages, agriculture, earth-moving, energy, mining, automotive, healthcare and education, with each division a leading national player. How he came into wealth. Unlike wealth tied to offshore assets or a one-time privatization, Osama's fortune was built by compounding local operating cash flows in businesses that touch everyday life: wheat milling, Sega flour, dairy, bottled water, juices, and beverages, including the sole bottling and distribution franchise for the Coca-Cola Company in Sudan since 2002. That portfolio created vertical integration across Sudan's food chain: procurement, processing, cold chain, route to market, and a durable moat in a country where supply chains are hard to replicate. The automotive/engineering lines, DAL Motors and DAL Engineering, reinforce that moat by providing hard assets, spares and service to agriculture, construction, and logistics customers. In a low-trust, low-infrastructure environment, the ability to deliver parts, technicians, and credit on time is itself a competitive advantage. DAL's origin as a service company created that muscle early. A concise public snapshot shows DAL as Sudan's largest private group with thousands of employees across these verticals. 3 things stand out about Osama's role inside Sudan. He underwrites food security capacity. DAL's flour mills, Sega, dairy and beverage plants are core nodes in Sudan's daily calorie supply. When international wheat markets whipsaw or fuel logistics falter, firms like DAL decide which lines keep running and where trucks go, a practical influence that exceeds anything measured by a stock quote. Multiple independent sources, including development notes and UN/NGO assessments since 2023, underline how processing and distribution capacity are decisive for Sudan's food availability during conflict. He runs Sudan's most complete private logistics/sales machine. The Coke franchise water brands Safia, Rawan and Juices, Rio, Bibo, demonstrate a long-running ability to operate to multinational QA standards under Sudanese constraints. He invests in institutional spillovers. DAL founded Khartoum International Community School and supports cultural programs, like traditional food and music festivals, signaling a view of the private sector as social infrastructure when public capacity is thin. That whole-of-ecosystem posture is part brand logic, part nation-building, and, importantly, part talent strategy in a market where firms train their own workforce. Why Osama Daoud matters. He is Sudan's most consequential home-based private operator. While some wealthy Sudanese are diasporic, DAL's center of gravity has remained domestic. That on-the-ground commitment means the group's decisions directly affect employment, prices, and availability week to week. He demonstrates how a service lineage can seed a fast-moving consumer goods empire. Starting from tractors and parts, he built a food and beverage machine with national reach. The engineering DNA, field service, parts, uptime, became a competitive edge in consumer staples. He's built bridges to standards and capital. The Coca-Cola franchise and modern dairy/juice plants import not just syrup or equipment but process discipline. AFDB and other financiers treat DAL as a credible private counterpart in an otherwise high-risk market. Bottom line, Osama Daoud Abdellatif's story is less about spectacular M&A and more about operational sovereignty. The ability to source wheat, keep plants running, and deliver staples to stores and tea shops through political and macro shocks. That is what home-based tycoon really means in Sudan today, and it's why his chairmanship of DAL Group remains central to the country's economic survival and eventual recovery. Now let's see what Libya has been up to. Libya's wealth is mostly public oil money, not private fortunes. Revenues flow from the National Oil Corporation, or the NOC for short, to the Central Bank of Libya, or the CBL for short, and pay a vast salary bill, fuel subsidies, and imports. Because the state controls the cash spigot, the people who hold power are those who can gatekeep access to budgets, letters of credit, customs posts, and security for oil terminals, rather than conventional billionaires. When the Gaddafi state collapsed, formal institutions fractured and local networks filled the vacuum. Power concentrated around city militia coalitions like Misrata, Zintan, Tripoli, and tribal blocs, notably in the east and south, and a handful of political families that combined armed influence, patronage, and business ties. Three groupings matter most today, with the first being the Haftar clan led by Field Marshal Khalifa Haftar, who emerged from the anti-Gaddafi uprising as the dominant military figure in the east. He built the Libyan Arab armed forces by stitching together ex-army units, tribal auxiliaries, notably from the Awaker, Obeidat, and other eastern tribes, and Salafi currents aligned with order-first politics. The Libyan National Army leveraged control of the oil crescent terminals, which are home majority of Libya's oil reserves, to extract budget support, appointments, and project funding, without formally touching oil sales, which legally remain with the National Oil Corporation. It also benefits from fees along smuggling/counter-smuggling chains, customs, and reconstruction contracts in Benghazi and Derna. External patrons, historically Egypt and the UAE, at times Russian security contractors, provided training, equipment, and political cover. The Husni Bey Group. Amid the militia political struggle, a handful of private business houses kept basic consumer markets alive. Foremost is Husni Bey Group, led by businessman Husni Bey. Its significance is HB Group became a crucial conduit for food staples, fast-moving consumer goods, household goods and retail, partnering with international brands and using nationwide warehousing and logistics to push goods across a fractured country. In a cash-starved, import-dependent economy, access to Central Bank of Libya letters of credit determines who can bring in wheat, milk powder, medicines, and hygiene products. HB Group's compliance and scale allowed it to operate even during sharp swings in the exchange regime. By securing bulk supplies and keeping distribution running through checkpoints and shifting front lines, HB Group helped blunt inflation spikes and shortages, particularly in Tripoli and the coastal strip. Is there a single, verified, richest Libyan? There is no reliable public ranking of this. Net worth data are opaque, assets are often held through families or abroad, and conflict economies blur private versus state money. Names that wield outsized economic clout like the Haftar and the Debeba families, or businessmen like Husni Bey are influential, but no audited figure is accepted as Libya's richest. Issad Rebrab is widely recognized as Algeria's wealthiest businessman and the architect of Cevital, the country's largest privately held conglomerate. A trained accountant from Kubi Wailia, he left teaching in the late 1960s to launch an accounting practice, then took stakes in metal fabrication firms through the 1970s and 80s. After much of his industrial base was destroyed during the 1990s violence, he rebuilt at scale by founding Cevital in 1998. Today the group spans agri-food, notably sugar and edible oils, retail and distribution, glass, appliances, logistics, and overseas industrial assets, making it the emblem of Algeria's modern private sector. Path to power and influence. Rebrab's rise married opportunistic deal-making with import substitution. Instead of relying on Algerian state monopolies, Cevital invested in large processing plants at the port of Baiheu and built export capacity to Europe and West Africa. He also acquired distressed assets abroad, like appliances and steel facilities in France, Spain, and Italy, giving the group foreign currency earnings and know-how. These moves, and Cevital's role in supplying staple foods, made Rebrab a key private counterweight in an economy dominated by hydrocarbons and state companies. Cevital remains family-owned. In July 2022, Rebrab named his son Malik as CEO as part of a transition, while Issad retained the patriarch role. Forbes continues to list Issad Rebrab and family as Algeria's richest, reflecting the family nature of ownership. Cevital's refineries and distribution networks influence prices, availability, and import bills for sugar and oils, critical in a country where food inflation is sensitive. Bottom line, Issad Rebrab parlayed post-war rebuilding into a diversified champion that touches Algerians' daily lives and gives the country a rare private sector player of continental scale. Despite periodic political headwinds, Cevital and the Rebrab family remain Algeria's best-known business dynasty and by most global trackers as its richest. Last but not least, let's talk about Mauritania. Mohamed Ould Bouamatou is widely regarded as Mauritania's most prominent private sector magnate. Born in western Mauritania and raised in a trading culture that prizes hustle and cross-border networks, he started out in commerce before moving into formal finance and diversified industry. He is best known as the founder of the General Bank of Mauritania and the Bouamatou Society Anonymous Group, a holding that over the years has spanned banking, import, distribution, manufacturing/processing, real estate, hospitality, and services. Alongside business, he built a philanthropic footprint, most visibly through a foundation and a noted ophthalmology clinic in Nouakchott that has sponsored large numbers of cataract surgeries and outreach programs. Politically, Bouamatou has had periods of proximity to, and later sharp friction with, power. During years of heightened tension with the presidency and security services, he spent long stretches in exile abroad while continuing to manage assets and support causes at arm's length. After a change in the political winds, he eventually re-emerged more openly in Mauritanian public life. Those arcs, ally, critic, exile, return, help explain why his name often stands for both business dynamism and debates about oligarchic influence. How he came into his wealth. Number 1. Banking as a growth engine. Founding GBM in the 1990s gave Bouamatou a scalable platform. Deposits, corporate lending, trade finance, and especially letters of credit for an import-dependent economy. In a country where access to working capital determines whether firms can bring in fuel, food staples, medicine, and equipment, a privately run bank with strong correspondent relationships became a pivotal profit center and a lever for influence. Diversified trading and distribution. Through BSA and affiliated companies, Bouamatou expanded into import, distribution, consumer goods, pharmaceuticals, industrial inputs. Control of warehousing, logistics, and wholesale networks lowered unit costs and strengthened bargaining power with both suppliers and retailers. In small markets, that scale confers durable margin. Number 3. Real assets and services. He reinvested cash flow in real estate, hospitality, and service companies clustered around Nouakchot's growing economy. Office space, hotels, and business services that feed on the city's role as a political and commercial hub. These hard asset plays hedge currency and liquidity risk while anchoring the group local. LY. Number 4. Regional networks and risk management. Mauritania sits at a Sahel-Maghreb crossroads. Bouamatou's companies developed cross-border relationships, banking correspondence, suppliers, and diaspora clients, spreading risk across multiple jurisdictions and plugging the group into capital and goods flows broader than the domestic market alone. Philanthropy and social optics. The Bouamatou Foundation and the Eye Clinic have delivered visible social goods, particularly free or subsidized eye care, which softens the perception of a purely extractive elite and fills genuine service gaps. Bouamatou's story tracks the evolution of Mauritania's modern private sector, from merchant trade to bank-anchored conglomerate, from local shop floors to regional finance and logistics, from ad hoc philanthropy to branded social programs. His companies help move essentials through the economy. His bank helps clear payments and LCs. His foundation treats eyes and, symbolically, tries to help the country see a path to development. Whether one views him chiefly as a nation-builder or an oligarch, the practical reality is this. Mauritania's growth needs capable domestic firms that can complement the state, crowd in investment, and professionalize services. Bouamatou's rise shows both the promise and the tensions of that model in a young, resource-lean, trade-dependent economy. North Africa's wealthiest men and families have acted like oversized gears in relatively small, undercapitalized economies, sometimes powering the machine forward, sometimes grinding it. When you track the arc from Casablanca to Cairo, common patterns emerge. Business dynasties professionalize trade into banks, industrial groups, retailers, energy companies, and logistics platforms. Think of finance and conglomerates such as Othman Benjelloun's banking empire in Morocco, Issad Rebrab's Cevital in Algeria, the Sawiris family's construction, telecom, and fertilizers footprint in Egypt, Aziz Akhannouch's energy and retail holdings, or Mohamed Ould Bouamatou's banking and distribution in Mauritania. In states where public capacity is thin, their firms supplied the missing connective tissue. Letters of credit that keep imports flowing, mills and refineries that turn raw inputs into staples, and ports, fleets, and warehouses that knit the region into global supply chains. The upside is tangible. These groups employ hundreds of thousands directly and indirectly. They train managers, engineers, and auditors. They pay taxes and anchor capital markets. They underwrite hospitals, scholarships, and cultural programs. Their ability to mobilize foreign exchange and counterparties smooths shocks, food, fuel, fertilizer, when international prices whiplash and public procurement lags. In a region where SMEs struggle to scale, big balance sheets can stabilize prices and shorten the distance from factory floor to household. But concentration has a cost. Outsized market share risks crowding out competitors and shaping regulations to incumbents' advantage. Political entanglements blur the boundary between economic success and access, especially where procurement is opaque and media ecosystems are fragile. In moments of upheaval, Tunisia's post-2011 turbulence, Libya's fractured order, elite networks can become power centers unto themselves, amplifying the stakes of patronage and eroding trust. The story is evolving. Younger heirs and professional CEOs are steering legacy groups toward greener energy, digital finance, and regional South-South corridors with West Africa and the Mediterranean. The best outcomes appear where states upgrade refereeing, competition policy, transparent tenders, independent regulators, and where tycoons embrace open standards, local supplier programs, and credible philanthropy that addresses systemic needs, skills, healthcare, climate resilience, rather than episodic prestige. So the conclusion isn't that great fortunes are inherently a problem or a panacea. It's that North Africa's biggest private actors are structural, too embedded to ignore, powerful enough to shape trajectories. When rules are clear and enforced, their capital accelerates diversification, jobs, and technology transfer. When rules are pliable, the same heft can harden inequality and stall reform. The region's next chapter will turn on that hinge, channeling concentrated wealth into broad-based prosperity with institutions strong enough to keep the game honest.